Hello. As you know, on July 8th, the New York Stock Exchange was shut down for about 4 hours between 11:32 a.m. to around 3:10 p.m. Now, the initial news that first came out as far as why the New York Stock Exchange was being shut down and all open orders were being canceled was due to a Chinese hacker attack. Now, when that became an implausible explanation because obviously, if a virus was planted by a Chinese hacker to shut down the New York Stock Exchange, they wouldn't be able to reopen that same day and have anyone believe them, because if a virus was powerful enough to shut the New York Stock Exchange down, then in order to totally clean up the system, retest the system, make sure that the virus still wasn't going to wreak havoc, they probably wouldn't need to keep the New York Stock Exchange shut down for at least 24 hours, if not longer. So when they decided that that explanation was implausible, they said, oh no, a couple hours into the shutdown, that it was not a Chinese a hacker that was responsible, but it was a technical glitch in an update to the system software. So first of all, why did they have to change their reason? That already is throwing a lot of question into the credibility of the explanation of why the New York Stock Exchange was shut down, when they can't even get their explanation straight, and they come up with one explanation, then change it 2 hours later and say, oh no, it wasn't Chinese hackers, it was because there's a system glitch. Now, there was a trader on the New York Stock Exchange that day that spoke on conditions of anonymity that said that the shutdown was due to a software update that happened before market open that Wednesday. When things weren't going well, then that's when they were given the official word that they were going to shut things down. Now, I'll tell you also why this is implausible, because normally, although the systems update, they did say that they completed the systems update before market open hours, and the glitches only started happening when trading occurred. Normally they would do something like a total systems upgrade during the weekends when they have 48 hours to test and make sure all this is done. And then normally if they do a systems upgrade, is to, for anyone that's familiar with IT operations at a company, they would do that on a mirror test site first. They would test it, make sure everything operationally was functioning perfectly, and then they would basically upload the update to the live site to make sure. Now, it seems like none of these normal protocols that would happen on a regular systems update happened with a systems update on the New York Stock Exchange, which makes zero sense whatsoever. So now I'm going to show you several charts that explain why I believe the bankers, the Federal Reserve central bankers, deliberately decided to shut down the New York Stock Exchange for nearly 4 hours on July 8th to prevent a stock market crash that was beginning to develop. Now, if you look at this first chart, which I'm going to insert right here, and then I'm going to come back to it, so check it out. Okay, so if you looked at that chart, what you were looking at was the Dow Jones Industrial Average Futures, okay, so which is another index of the U.S. stock market, okay, which takes basically is comprised of the 30 of the largest companies that trade on the U.S. Stock market by market capitalization. So if you look at the futures, you will see that the stock market, the futures were crashing twice before the markets even opened that day, at 7 a.m. and 9 a.m. And then once again, they started crashing at 11 a.m. So the interesting thing, if you want to go back and look at that chart, is that you'll see once the futures were crashing at 7 a.m., they tried ramping it up before market open, and they succeeded, but then they didn't succeed for very long, because at 9 a.m., futures started crashing again. What they do, they ramped up the Dow Jones Industrial Average Futures again, but then at 11 a.m., it started crashing a third time, basically within 4 hours. And then, is it a coincidence they just shut down the New York Stock Exchange at 11:30? I don't think so. I think because they knew that stock market rout was developing, and if they didn't shut it down, that U.S. stock markets could have crashed by 4, 5, 6% that day. Okay, so let's take a look at a second chart, okay, that same day. So what we're going to take a look at now is, okay, we're going to take a look at things from a macro level, just not that day on July 8th. And we're going to take a look at the S&P 500 index. The reason we're going to take a look at the S&P 500 index is that because 60% of all the trades of all the stocks that comprise the S&P 500 happen on the New York Stock Exchange. So when they shut down the New York Stock Exchange, they shut down 60% of the trading of stocks that trade on the S&P 500 index. Now, if we look at a macro level, which I'm going to show you right now, so I'm going to show you approximately the past 15 years of trading in the S&P 500, you will see that first thing actually I'm going to show you is the daily trading volume. So if you look at this chart, okay, take a look. This is the chart of the daily trading volume, and I've circled in red the day of July 8th when the New York Stock Exchange was shut down. Okay, so you looked at that chart which I just inserted and you say, hey, nothing really looks too abnormal that day. The trading volume was a little over 2 billion shares, which was pretty much on par with the rest of that week and the rest of that month. So nothing really looks abnormal until we break it down by the macro level and the micro level. So now I'm going to insert the 15-year chart of daily trading volume of the S&P 500. Okay, so take a look. So one thing if you notice by the green hours, that volume was rising in the mid-2000s when the US stock market's rising. Now that's healthy. Normally you would have increasing volume into increasing stock prices. But if you notice, since 2008, when we had the first manifestation of this global financial crisis, which really has not run its course at all, and there's a second phase that's going to be much more devastating than what happened in 2008 that is coming, you will notice that daily market trading volume has collapsed since then, even though the S&P 500 keeps rising. So you would see that when they first started recovering after the 2008 collapse, that daily trading volume was around 4 to 5 billion shares a day, and now it's collapsed to about 2 billion shares a day, with many months actually being less than 2 billion shares a day. So that is the sign of a totally manipulated, unhealthy market, because as you know, shares should rise in price. There should be more demand for the share, so more heavier volume trading, more buying as share prices rises. You shouldn't have collapsing volume into a rising stock market. So that's what I have shown you on that day. Now, even more interesting is if we look at things from a micro level. So what I'm going to insert now here is the 1 minute charts. So the intraday 1 minute charts for a 3-day period. So it was 1 day preceding July 8th, in which the New York Stock Exchange was shuttered by the bankers for 4 hours, and then the day of July 8th, and then July 9th, 1 day after. So take a look. Okay, so if you look at two things should have stood out to you. You should have seen in the red box, which I circled, massive trading volume, which was nearly 500 million shares were dumped in the S&P 500 index shortly after the bankers shut down the New York Stock Exchange at 11:30. So right after 11:30 happened, there was a massive dump of nearly 500 million shares on the S&P 500 index. Now, if you notice, if you need to go back, you can go back to that chart. There is a small, really thin baseline daily trading volume, which I also circled in red, and you can see that during the 1 minute intervals, that normal trading for those 3 days was around 2 million shares per minute during that time in the S&P 500 index, but nearly 500 million, or nearly 500 million shares traded in 1 minute shortly after the bankers decided to shut down the New York Stock Exchange. So what was going on? Now, I've already told you that 60% of the trading volume of the S&P 500 happens on the New York Stock Exchange. So by shutting it down, they shut down 60% of the trading volume. So if they didn't shut down 60% of the trading volume, then instead of 500 million, would a billion shares been dumped? And would we had have experienced a massive rout of the S&P 500 losing 5, 6, 7% that day. I say that was very possibly why the bankers shut down the New York Stock Exchange for 4 hours that day. Because there's a couple things that you need to understand about how trading works on these different exchanges, because the mainstream media right after that happened said, hey, no retail investors having a problem selling any components of the S&P 500. So really the shutdown of the New York Stock Exchange is not adversely affecting anyone anyone at all, which is true in the fact that's not affecting retail investors, because retail investors trades never get shuttled and executed through your New York Stock Exchange. It's only institutional trading that normally gets shuttled to the New York Stock Exchange and execute. So it's actually irrelevant if the New York Stock Exchange was shuttered every single day, every day. For the retail investor, they'll still be able to make the trades. But the mainstream media put out this narrative like that it was no big deal that the New York Stock Exchange was shut down because it's not affecting anyone. That's total garbage, because institutional investors trade on the New York Stock Exchange. So when you're shutting that down, you're affecting all the institutional traders. So normally, if you don't know, institutional traders place trades to execute at market close. Right? So, but if you look at 500 million shares, that's not a retail investor. So what happened is, if you see that it happened right after the bankers shut down the New York Stock Exchange at 11:30, the 500 million shares were dumped of the S&P 500 index. What is really going on is that because they couldn't execute their sales on the New York Stock Exchange, they probably went to other exchanges then to dump, because that was definitely an institutional investor, not a retail investor that's dumping 500 million shares in the S&P 500 index. So as I said before, how many more shares would have been dumped? Now the other if the bankers had not shut down the New York Stock Exchange. Now, the other interesting thing you probably noticed was the fact that I circled a massive spike where the S&P 500 was ramped up the very next day at market open. Okay, so I'll tell you why that happened. Because like I said, most likely institutional traders were forced to trade on the other open exchanges where they could get their sell orders executed, and to convince these institutional traders not to keep dumping their shares, the banks artificially ramped up the S&P 500 the very next day at market open, because that is not a normal looking spike at all, because it went vertical. It was not even parabolic. You can't say, because parabolic's more like this. It went vertical at market open the very next day. Okay, so there was a definite method to the central bankers' madness as far as why they executed that ramp up the very next day. And also, okay, there was one other chart I want to show you, because at market close that day, remember I told you most institutional investors place trades at market close. So you will see that the top components of the S&P 500, if you go back and check the 1 minute charts of the top S&P 500 components, like Microsoft, Apple, Exxon is another one. Apple, Exxon, Microsoft. I'm going to show you one because they all look the same. You can go verify this for yourself if you want to go back to July 8th and look at the 1 minute charts. But there was massive dumping of the top components of the S&P 500 at market close on July 8th as well. So they still didn't stop, even though they tried to keep ramping up the US stock markets that day by shutting it down. They still did not stop institutional investors from dumping massive shares of the S&P 500 components at market close that day. So that's why the ramp up was necessitated the very next day. So I think basically what happened that day, as you can see from the massive dumping of Dow Jones futures, and then the ramp ups that failed, and then to the eventual shutdown, to the massive dumps of the S&P 500 components at market close that day, to the massive nearly 500 million share dump of the S&P 500 index that happened shortly after the bankers shut down the New York Stock Exchange, shortly after 11:30 a.m. on July 8th, that you can see that the US stock markets were probably the beginning phases of sustained rout that was coming, and the bankers stopped it. But in the end, let me assure you that the emperor will be shown to have no close, because all these artificial manipulations and illegal manipulations of the US stock market will come home to roost. These ramp ups will not be sustainable, because in the end, unless you just want to shut down the markets all day, because what the US Federal Reserve bankers did by shutting down the New York Stock Exchange on July 8th is tantamount to how the PBOC, People's Bank of China bankers, tried to stop the rout that was the ongoing rout that is going on in the Chinese stock markets. Because as everyone knows, the Shanghai Composite dumped 35% in less than 4 trading weeks, and the Chinex, which is the equivalent of the Nasdaq in China, dumped more than 40% in about less than 4 weeks in China. In order to stop that, they said, hey, we're gonna make we're gonna just halt all trading of I don't think it was all trading, but it was a large portion of the Shanghai Composite. And then they said anyone that owns more than 5% any company that trades on the Shanghai Composite, it's illegal for you to sell. And then they said we're going to arrest anyone that we feel is trying to manipulate the stock market down. So you notice they never say anyone manipulates the stock markets up. That's how bankers are so shady and so deceitful. And they never have a kill switch when the market's going up, but they see the first inkling of a rout coming on, then they have a kill switch. So in China, basically they said, hey, we're going to make it illegal for you to sell. We're going to prosecute and arrest those who we feel are trying to manipulate down, which is basically means any large seller. And when you say arrest, you have a possibility you could be executed. So that's truly a kill switch and more sense than one for the Chinese stock market. The Fed Reserve just happens to have that kill switch too, which they completely halt all trading on the New York Stock Exchange. But what can they do? Can they keep halting all trading on the New York Stock Exchange in the future every time this happens? I don't think so. So you have been forewarned that eventually all these shenanigans, all this fraud, all this deceit is going to come home to roost. So thanks a lot for watching. Let me know what you think. Please do comment below. Please don't forget to subscribe, and as always, remain intensely curious. Until next time, so long.